Welcome to Unintended Consequences, episode F45. It's July 1st, 2026. Today's case is a reminder that complex systems rarely respond the way we expect them to. Post-war mortgage subsidies made homeownership reachable for millions of families and built the car-dependent, racially segregated suburbs that later proved nearly impossible to change. In 1949, a veteran named William Levitt bought potato fields on Long Island. He began selling houses for $7,990 with no down payment for eligible buyers. The houses came with VA guaranteed loans and FHA mortgage insurance. Those were exactly the tools Congress had created to turn returning service members into stable homeowners. Within a decade, the same pattern repeated across the country. It produced both record home ownership rates and a landscape of single-family neighborhoods that required cars for every trip. The policies grew out of the housing collapse of the 1930s. They also responded to the need to reintegrate millions of veterans after 1945. The FHA had been created in 1934. The VA loan program was authorized by the 1944 Servicemen's Readjustment Act. Together, they offered federal insurance and guarantees that lowered the risk for private lenders. Lawmakers saw home ownership as a source of family stability and economic security. Rental housing was scarce at the time. Memories of bank failures remained fresh. The mortgage interest deduction had already been on the books since the Income Tax Code of 1913. It further reduced the effective cost of borrowing. At the time, these measures looked like straightforward ways to expand access without direct government construction of housing. Officials expected the benefits to reach the broad middle of the workforce that had been shut out during the Depression. Between 1945 and 1960, the FHA and VA backed more than 10 million new homes. Most of them stood in newly built subdivisions outside central cities. Developers such as Levitt and Sons used standardized plans and FHA minimum standards to produce thousands of units quickly. Local governments extended roads and utilities to the new tracts. Early results appeared strongly positive. The national home ownership rate rose from roughly 44% in 1940 to 62% by 1960. Congressional reports and housing agency press releases described the programs as engines of broad-based wealth creation. A few planners and urbanists noted that the underwriting rules favored new construction over existing neighborhoods. They also observed that racial covenants were still common in the deeds. Yet these observations stayed at the margins of policy discussion. FHA and VA appraisal standards treated racial homogeneity as a marker of neighborhood stability. Loans therefore rarely reached black buyers even when they could otherwise qualify. The result was a widening gap in household wealth that persisted for generations. At the same time, the combination of cheap mortgage credit and federal highway construction after 1956 made distant greenfield sites economically attractive to builders. Families moved outward, retail followed. Local governments zoned almost exclusively for single-family homes to protect property values. Transit ridership in many metropolitan areas began a long decline as daily travel distances grew. By the 1970s, the same policies that had produced rapid housing supply also locked in high per capita infrastructure costs. They locked in elevated carbon emissions from commuting. They limited the ability of later planners to introduce buses or rail without crossing low-density subdivisions. Second-order effects appeared in school funding, which remained tied to local property taxes. They appeared in municipal budgets that struggled to maintain roads and pipes spread across ever larger footprints. Fair housing legislation in 1968 and the Community Reinvestment Act of 1977 attempted to correct racial exclusion. Yet the spatial pattern of development was already fixed. Later efforts to add density or transit encountered resistance from residents who had purchased homes under the original rules. Some metropolitan areas experimented with growth boundaries and inclusionary zoning. These measures operated inside a built environment shaped by decades of federal mortgage support. Today, the mortgage interest deduction remains in place. It continues to favor larger, newer homes farther from job centers. Many cities still struggle to finance transit extensions into the same low-density areas. Incentive structures that lower the cost of one activity without accounting for its spatial footprint tend to produce durable physical outcomes that later generations inherit. Once capital is committed to dispersed infrastructure, reversing course requires either large new subsidies or politically difficult changes to property rights and taxes. The post war housing programs show that design choices made for immediate access can constrain future options more tightly than their authors anticipated. When evaluating similar large scale subsidies today, it is worth asking what physical and social patterns the incentives will reinforce over a 50-year horizon rather than a 5-year one. That's the case for today. The lessons tend to travel further when you share them. So send this one to someone who'd find it useful and subscribe wherever you're listening. See you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. And before you go, this show is part of the NARA Network, a family of daily podcasts on tech, science, and markets, each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. Models and Agents for Beginners, Artificial Intelligence Explained Simply for Beginners and Curious Teens. Find every show free at naranetwork.com. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.